In September of 2025, OpenAI signed a $300 billion deal with Oracle. This news triggered a 50% rally on Oracle stock. Oracle used this bump in valuation to fund a huge purchase of Nvidia's hardware. This new demand sent Nvidia stock soaring to new all-time highs. Nvidia then proceeded to commit $100 billion back into its partnership with OpenAI. It looks like money in the AI industry is beginning to move in circles, with Nvidia, the AI Wall Street darling, being at the center of it. Some are calling all of this a Ponzi scheme. But it's only a Ponzi scheme if there's no real value underneath. Oh wait, according to a recent MIT study, 95% of corporate investments in generative AI have so far produced zero return on investment. Since this study was released, the short-term use case of artificial intelligence has come into question. OpenAI has recently pivoted to animated video generation and even sexual content, not exactly the promised technological disruption that AI was supposed to be. Keep in mind the Nasdaq 100 has more than doubled since ChatGPT was released, going practically parabolic recently, with AI-related stocks like Nvidia driving a good chunk of this rally. But if 95% of AI's real-world use case has zero return on investment, this is not a setup that can end well. The question is, how far is this going to go, and how long this frenzy can last? The same MIT study that we mentioned earlier also found that 40% of businesses have successfully implemented AI large language models for simple tasks like drafting emails, summarizing texts, and note-taking. The study also points to what they call a shadow AI economy, where employees are increasingly using consumer AI tools. So on the consumer and employee level, there seems to be a real adoption and a real use case for AI. So the technology is likely improving productivity at the individual level. The problem is that the billions of dollars being invested into AI were not meant for individuals. They were meant to help businesses automate and streamline costs to potentially save trillions of dollars in labor costs. That's what the initial excitement was about. Even if AI might improve productivity at the individual level, it's very unclear whether that actually translates into higher corporate profits at the business level, or if it simply means that employees are just able to produce the same output at a faster pace. If this is the case, it would not justify the massive capital flows that have been going into AI. Just Alphabet, Amazon, Microsoft, and Meta are spending $300 billion in 2025 alone on artificial intelligence. That accounts for 1.2% of total US GDP, which is significant to say the least. Now, to be fair, companies spending too much on AI is not a problem on its own. It becomes a problem, however, when this spending is being financed through debt, and that's what's happening right now. Google alone has accumulated $10 billion of debt just in 2025, Meta $28 billion since 2022. Microsoft's debt pile has jumped from $27 to $46 billion just in the past year. Oracle, now one of the biggest names in AI, is carrying close to $90 billion of debt and ramping it up every quarter. Just in 2025, US tech firms have issued about $157 billion in bonds, which is a 70% increase compared to last year. According to JP Morgan, AI-related debt now accounts for 14% of the total corporate debt market. If you know anything about how debt works, you'll know that this is money that needs to be paid back with interest. So in other words, companies that are borrowing to spend on AI need AI to produce a return on investment to justify the debt that they have taken on. And today, the reality is that the short-term return on investment of AI is extremely questionable, which could lead to financial pain and defaults once the debt comes due. We saw something very similar happen with internet stocks in the late 1990s. The top 10 largest companies in the US were spending billions of dollars on internet infrastructure fueled by the excitement from investors, just like today. These were companies like IBM, AT&T, Cisco, Walmart, Intel, General Electric, and Microsoft, all stocks that were melting up in the late 1990s. Many saw the situation for what it was, a disconnection from reality. We selected a few articles from back then that were warning about stock valuations not being supported by fundamentals, that many tech companies were spending enormous amounts just to keep up with the constant change in the industry, and that expectations had become detached from financial reality. Stanford University published a report cautioning that the technology sector had grown so large that it was creating structural imbalances imbalances in the economy, and finally Nobel Prize winning economists like Robert Shiller were also expressing concerns about speculative behavior in the tech sector. And as history would later prove, all of these concerns were indeed entirely justified. The Nasdaq 100 lost 80% of its value from its 1999 peak, and many smaller tech firms went completely bankrupt under the weight of the debt that they had taken on. But notice the dates on these articles. This is from 1996, and these two are from 1997. If we look at a price chart of the Nasdaq 100, it was right at this moment. Internet stocks were already in a melt-up in 1997. That was the moment where internet stocks began to go parabolic. But the peak of the market only came in March of 2000, a full 3 years later. This is a perfect example of how the market can remain irrational longer than you can remain solvent. Traders who joined the party in the late 1990s made a fortune for multiple consecutive years. Of course, many of them lost everything when the bubble eventually popped. So is the AI bubble closer to 1996 or 1999? Well, we actually know exactly what triggered the implosion of the bubble in 1999. If we put the Federal Reserve's interest rate on top, we see the US central bank was generally lowering their interest rate during the late 1990s. This created looser financial conditions that made investors confident they could safely continue bidding up internet stocks. In 1999, however, they began to raise their interest rate in an effort to cool the market down. And it worked. The bubble popped and it unwinded. We think we could be following a similar playbook today. If we look at the semiconductor ETF in 2025, which is arguably the most AI-related basket of stocks, we see that it's also going parabolic right now as its rate of ascension seems to be accelerating. If we add the Federal Reserve's interest rate on top, we see that they've also been lowering interest rates recently, helping fuel speculative behavior. As long as the Fed keeps rates low and steady, it's likely that the speculation will only ramp up from here. When the Fed decides to begin raising interest rates, however, we'll know that the peak is very close. We were on record several times during the 2025 market correction to say that semiconductors were a huge buying opportunity before things were going to get crazy once again. We've been riding several semiconductor names like ACMR, Applied Materials, ASML, and Nvidia for some incredible returns at Bravos Research over the past few months. And believe it or not, we intend on continuing to do so as long as we believe that conditions remain favorable. If you're interested in getting access to our entire trading strategy with real-time alerts for every trade that we take and clear, actionable updates on our entire trading strategy, make sure you are a Bravos Research member by clicking on the link down below. You won't regret it. Thank you for watching.